Good morning, everyone. Welcome to the first in a new series of Fireside Chats sponsored by the Black Economic Alliance. On behalf of Charles Phillips, my co-chair, David Clooney, our executive director, and the entire board of directors for the Alliance, we're delighted that you've joined us today. It's clear that none of us have ever seen anything like what is confronting us today, with an invisible adversary that clearly knows no boundaries, respects no social class, and has caused the entire globe to grind to a halt. We decided that we could continue to service our membership by bringing some of the nation's top experts to discuss with us those topics that we most want to hear about. What are the prospects for when this current crisis might end? What are the personal and the national security issues we should be focusing on? And what will be the impact on this country in the aftermath of this ordeal as we put the pieces together again, economically, politically, socially, and personally? Joining us today is Steve Rattner, a member of the Black Economic Alliance and a good friend to many of us. Steve is the chairman and chief executive officer of Willett Advisors, LLC, the investment arm for former New York City Mayor Michael Bloomberg's personal and philanthropic assets. In addition, he serves as the economic analyst on MSNBC's Morning Joe and is a contributing writer to the New York Times op-ed page. And perhaps most relevant for today's conversation, Steve previously served as counselor to the Secretary of the Treasury and led the Obama administration's successful efforts to restructure the automobile industry. Steve has written prolifically on the topic of the economic impact of the coronavirus epidemic or pandemic, and you can review recent commentary in his March 23rd op-ed in the New York Times, "We all hate bailouts, but we need them," and we'll hear more about that from him today. Moderating our session today will be Charles Phillips, BEA co-chair and a member of the New York Federal Reserve Board. Charles's unique perspective from this perch will help us set great context for the discussion today and help us with some answers to your questions. As usual, questions have been submitted in advance, and we will do the best we can to get to as many of them as we can today. Without further ado, let me turn the program over to Steve for some opening comments, and then we'll take your questions. Steve, thank you for joining us today.
Tony, thanks so much for having me. It's a privilege and an honor to speak to this group, to be your first speaker in this series. I feel like I'm always in demand when the world is ending, which is not always the best feeling to have. But in any event, I was very honored also to be among your first group of contributors. I think you guys have done amazing stuff with the Black Economic Alliance, and certainly needed now more than ever, given what's going on in the world. So Charles and Tony and I have talked a bit about this, and what I'd like to do is run through just a few slides to set the framework of both what's going on in the economy now, what the government is doing in response, and what the immediate economic outlook is. And then we can do some Q&A over where we might go from there, what else might be needed, all the kinds of questions that I know some of you have submitted and that Charles and Tony have put together. So if we could go to the first slide, I think by now probably most people are familiar with the first piece of major economic news that's come out since this all started, which is the new claims for unemployment insurance number that it's released every Thursday. And what I've done here is I've tried to compare what happened yesterday with what happened in the Great Recession. So across the bottom, the dark gray line is the pattern of the new claims for unemployment insurance during the Great Recession. And you can see that it started at about 344,000 a week, which was a fairly normal number. It crept up gradually. It got a little bit over 600,000 at its peak. But as you can see, very modest rise and decline. And even with that, we had over 10% unemployment at the peak of the Great Recession. And then the dark blue line on the left, which starts actually below the dark gray line, meaning that our economy was running closer to full employment before this happened, only about 200,000 new claims a week. And it literally shot up to 3.3 million. If any of you have seen the New York Times or the Wall Street Journal today, they have huge front page graphics about this. It's utterly unprecedented in American history, and is simply a sign of what we all know is going on out there, which is to say the economy has more or less, shut down might be an overstatement, but dramatically decelerated. And so we expect to see rising unemployment. There's disagreement among economists about what next week's unemployment figures will show. We're in uncharted waters in terms of our ability to forecast these things. but I think what we all know is it's going to be bad. And if we turn to the next slide, what you'll see is the impact of this on the broader economy. And I'm simply using gross domestic product, GDP, as a proxy for all economic activity. And so on the left, we go back to 2006, before the Great Recession, and you can see generally positive economic growth. You can see the downturn from the Great Recession. GDP never declined by as much as 10% in a single quarter, and then it began to grow again late in 2009. And then you can see all the way over on the right, these happen to be JP Morgan's forecasts, but the banks are essentially in a very similar place. You can see all the way over on the right what's expected, which is a very substantial down first quarter GDP number, which will get reported the next couple of weeks, about 10%, and then a huge minus 25%. These are annual rates. Doesn't mean the economy will shrink by 25%. That's an annual rate. But if you put those two bars together, you would have a recession of substantially greater magnitude, 1.5 to 2 times greater than the Great Recession. Then you see after that, JP Morgan and other banks are forecasting a fairly sharp rebound, and we should talk about that in our discussion because I think there's a large amount of uncertainty around that. But in any event, JP Morgan expects GDP this year to decline by 6.7%, which would be 50% more than the decline during the Great Recession just over this period of time alone. And what's also interesting to note is as recently as March 6th, so less than 3 weeks ago, JP Morgan thought we were growing at 1.4%. So the economic situation has deteriorated extraordinarily quickly. Congress and the administration are responding much faster than we did last time. I think this is among the lessons learned. If we turn to the next slide, you can see what is in the magnitude of the stimulus bill, which we hope is going to pass the House of Representatives tonight. This is all in record time, which has some pluses and minuses that we can also talk about. We've learned a lot from the 08-09 experience and how to deal with these things, and I think that's all to the good. But just to put this in perspective, the dark blue bar, the third bar down, is the amount of spending under this coronavirus bill, $2.2 trillion, by far the largest stimulus bill ever passed by Congress. The Obama stimulus bill was in the high $800 million range, and I think that would have been the largest until this. So you can see the magnitude of this response. I'm comparing it to a couple other things to give you a sense of what we're talking about. It's almost exactly 1 year of annual spending by the federal government. So 4.45 trillion we spend every year. This is 2.2 trillion on top of that. Won't all be spent this year, but a lot of it will be. And then I compare it also to tax revenues, 2/3 of our tax revenues, and almost 4 times what we spend on defense. I should also mention here that a portion of this, a significant portion of this, 425 billion to be precise, is going to be put into a fund that the Federal Reserve will be able to leverage 9 to 1 and produce another 4.25 trillion of stimulus. So the total amount of money going into this economy will be something north of $6 trillion. Again, completely unprecedented in our history, but it is quite accurate, I think, to say that the challenge is also unprecedented in our history. And then to dig into the details for a second, if we turn to the next slide, you can see what some of the major components, and I'll just go over these briefly and then happy to, in the Q&A, drill down on whatever people want. So the biggest single piece is lending, mostly to large business, some of it to local government loans. Inside of this $508 billion is the $425 billion that I mentioned that is going to be leveraged by the Fed in ways that we can describe. The remaining part is going to go to airlines, to other industries deemed critical, and things like that. And then there's the small business piece, which is about $370 billion, $75 billion. And that is obviously designed to help small business. We can talk about how that works. The next line down are the one-time rebate checks that you've all read about, and that's $1,200 per individual. They phase out above $75,000 of income, but for people in the middle class, the working class, upper middle class, it's $1,200. And to put that in a bit of perspective, in 2008, the Bush administration, as the recession was unfolding, got a stimulus, a similar type of one-time rebate passed in Congress. That was $300 per adult. And so this is 4 times the size. So $1,200 may not sound like a game changer, but it is 4 times the size. There's a bunch of business tax cuts in here that some of which, many of which I think are not the perfect public policy, but this bill, as I said, was put together very quickly, and a lot of stuff was sort of crammed into it, a fair amount of special interest stuff, not ideal legislative process, but probably necessary. And then you come to expanded unemployment benefits, and I'll also mention this in the context of health spending. The original Republican bill had very little, if anything, in these kinds of categories. The Democrats do have essentially a veto over this bill by virtue of controlling the House and by virtue of the Senate needing 60 votes to pass most kinds of legislation. And so Chuck Schumer and Nancy Pelosi were able to use that leverage to achieve substantial improvements in this bill from what the Republicans initially proposed. And the expanded unemployment benefits is one of the major hallmarks in which we are now going to provide $600 a week for 4 months to anyone who's unemployed, including gig workers, including furloughed workers, people who would not normally qualify for unemployment. And if you take that $600 and you put it on top of state benefits, which are vary greatly, but let's say $300 is a rough average, you're getting to $900 a week, which is close to $45,000 or so a year, which is essentially average wages. And so the unemployment benefits here are going to be, again, not necessarily going to change everything, but they're going to be very substantial relative to past provisions like this. And health spending also, about $175 billion going to hospitals and other healthcare providers, and also money to state and local governments. You probably saw, some of you may have seen Governor Cuomo yesterday complaining that New York was only getting $5 billion. I'm not saying he's wrong to complain, but we are at least getting some money out to the states and local governments. And then you see some smaller categories below. So that's roughly where the money is going. And I think I should stop here and let Charles chime in with whatever questions or response he'd like to offer.
Great, thanks, Steve. That's a good overview. And let me start by thanking you for being an early supporter of BEA. You've been behind us the entire way. But you have a unique perspective on all this, participating in the bailout programs from 2009, particularly the auto program, and all the stimulus programs around it. We're in unprecedented territory, as we mentioned. The New York Fed thinks GDP is down 16% this month, year over year, which is a shocking number. I had to ask them to repeat it a few times. And that will be at 11% unemployment rate by the end of the year. So with that context, still looking at the stimulus package, so now you've had a chance to look at it. What parts of it are the most effective that you think were a great idea? And then what parts are kind of unneeded, inefficient? What's the slush fund part of this that we could possibly remove and put something else in? Just like get an assessment from you.
Yeah, look, as I said, normally the way Congress operates, the administration sends a proposal, they have hearings, they bring in witnesses, they debate it, they discuss it, they draft it, they amend it, and it all takes a long time. But by no means does it produce perfect legislation, but at least everyone's had a chance to really go through it. This was put together in literally a couple of weeks. And so inevitably there are pieces of it that are not ideal, not designed well, whatever. So I'll give you 1 or 2 examples. On the small business side, I think the amount of money going to small business is going to prove to be substantially inadequate. I think relative to the criteria they've set out for small businesses to qualify for these loans/grants, I think the demand could well be in the $1 trillion range or even a bit more. And so I think there was a bit of shortchanging of small business here. This was a Marco Rubio provision. He chairs the Small Business Committee, and it operates through the Small Business Administration, which is one of the less efficient arms of the government. I probably would have done that differently. So there's a lot of details in how a provision like that works that I would have done differently. But in any event, it's probably too small. On the other side, there is a ton of money going into larger businesses, and especially when you add the leverage by the Fed that I described. But the Fed is only able to lend or buy debt, and Charles will correct me since he's on the board if I get any of this wrong, but I believe the Fed is only allowed to, really allowed to lend or invest in companies that are investment grade. The Fed has to know it's going to get its money back. And the problem is there are a lot of companies between these safe, secure companies and the small businesses that are not in good shape and are going to need some kind of help, or they may well end up liquidating. The Fed is supposed to be announcing something called the Main Street Lending Program. We don't know what that means yet, so there's more details to come. But I do worry about the amount of support in here for this middle group of companies that are not the strongest companies and also not the smallest businesses. And I do worry a bit about the small businesses. You know, it's a lot easier to shut down a business, a small business, than it is to reopen it. You know, a restaurant can close in an instant, but bringing back the band, so to speak, of the capital you need, the lease, the employees, and so on is hard. And I don't know that we've done enough. I think that I think there's a general feeling that this is not the end of what the government's going to be doing here, that there'll be a phase 4, and we need to see how this all unfolds to know what that should be. There are clearly enormous pressure points across the whole economy here of every kind of business, nonprofit, as well as, of course, the ordinary Americans who are suffering and will not be directly helped by this bill, will probably need more.
So relative to 2009, you know, the checks are going out faster, they're bigger checks. And more of the 2009 package was in the form of tax relief. Do you think if you add all that up together, the recovery from all this is much faster? Is it more of a V shape versus a U and L shape? People kind of want to know what's the time frame in your mind before we kind of get back to some semblance of normal.
Yeah, so I think that that's fair, Charles. So a couple of thoughts about that. First, giving people money is fine, necessary, important at this moment, but there are two other aspects of that that should be noted. One, of course, until people can go out and spend that money, it isn't really keeping the economy going. It's providing them with a financial cushion, but unless they do something with it, it doesn't really help the economy. And secondly, at the moment, I think probably most of the people on this call are working remotely. Most of us probably work in businesses where you can work remotely, and we have to work remotely because we all have significant jobs to do. But many, many people in this country are not working, not generating income, not creating GDP. And so the consequence of that is the kinds of GDP numbers that you just saw a little while ago. And that is a significant and direct hit to our economy. If people don't work, you don't have GDP, you don't have income, and so on. Now, in terms of the shape of the recovery, so that sets the stage a little bit for some comments on the shape of the recovery. First, it's worth noting that in 2008, 2009, it took roughly 25 months for the number of jobs to go from the highest level it was before the recession down to the trough at the bottom of the recession. And it took 50 months for the number of jobs to return to the level of the number of jobs there were before the recession. I've been having this debate with Larry Summers the last few days. And so my view anyway is that there's an asymmetry between economies going down and coming back up again, a little bit like the analogy of the restaurant owner. It can go down pretty quickly. It goes back much more slowly. So I think this recovery is not a full V. I don't think that we simply bounce back in the third quarter whenever we're all allowed to go back about our business and the economy goes right back to where it was before. And I would also cite one little piece of, I guess, evidence in a sense that if you look at China, which as probably everybody here knows, obviously, of course, was the beginning of this, but then took some very draconian measures to they quarantined 507 million people. They essentially went full force against the virus, and they did stop the spread very quickly. But if you look at the economic data coming out of China, which is obviously sketchy, but still there is data, it looks like the Chinese economy is at about 70, 80% maybe of capability. It's not all the way back. So I do expect that this recovery is probably going to be slower than a lot of people think at the moment, and that may get us again into a phase 4 of stimulus or something like that.
What's the impact for printing so much money like this? I mean, before we thought we could never afford something like this. I know the modern monetary theory says that deficits don't matter, but does this catch up with us at some point?
Well, I'm not a great believer in modern monetary theory, but old-fashioned monetary theory would tell you, even a conservative economist like Milton Friedman from years ago would say that in a situation like this, this is where it does make sense to, quote, print money, either by deficit financing or literally printing money at the Fed, because that is essentially the government's job, is to essentially be the source of financing of last resort. I don't worry at this moment that there's any danger that all this money is going to recreate inflation. I think of all the things we have to, we didn't even have enough inflation before this started, let alone now. And so that part of the normal concern that people have, I would take off the table for now. The piece of this that I do worry in a sense a little bit about, but it is what it is that we already had a significant problem with a government deficit that many of us viewed as unsustainably large at $1 trillion. This adds we had around $20 trillion of government debt. This adds another $2 trillion on top of all that. And there's no issue about the United States' credit rating or people not buying our debt, or some of the things people have argued in the past as reasons for why we should have more restrained fiscal policy. What I always worry about in the context of deficits and debt is that we are essentially leaving these burdens to our children. This $2.2 trillion that is going to be borrowed is going to sit on the government's balance sheet. Yes, interest rates are very low, so the cost of servicing it isn't that great. But over time, rates will go up. The cost of servicing it will go up. The debt will be sitting there, and it is going to, in the future, squeeze federal spending, squeeze our ability for the federal government to pursue the kinds of policies and programs that we all wanted to deal with the pre-existing problems that we've had in this country across the income spectrums. And so it's not ideal. It's not ideal to incur this much more debt, to print this much more money. But I do think under the facts and circumstances, we're right to be doing it.
Okay, let's turn to maybe how much of this stimulus spending might make it into the Black community. There was an Ohio State study that looked at the 2009 package, and just to give you a few numbers, something like 1% of the federally contracted funds made it to Black businesses. Procurement spent about 5%. Asset managers received very little of the TARP program, which was a criticism. And the same study found about that a white-owned bank was 10 times more likely to receive TARP money than a Black bank, controlling for all other factors. So do you see any controls in this package that would prevent that from happening again, that we would have better monitoring so the people who need it the most, the businesses who need it the most, which tend to be emerging companies, and Black businesses participating in this a little bit more than they did last time?
And when you answer that, I've got a quick follow-on to that one.
Okay. There's a small amount of money. I forget exactly. I thought I'd written this down, but maybe I didn't. There's a small amount of money, $10 million, which is a really small amount of money.
Yeah, we were looking for a little bit more than that. Yeah.
Huh?
We were looking for a little bit more than that.
Yeah, I know. Believe me, there's a lot of injustices in this bill. And as I said earlier, when you go through it, there's all kinds of provisions in it. I haven't gone through it all yet, but I've seen bits and pieces of it that would not survive a more thorough inspection. So look, with regard to the support of minority businesses, minority investment firms, which I certainly think is very important, there is nothing explicit in this bill besides the small amount of money that we just talked about, but there's nothing explicit in this bill to require anything like that. I think what we have to look to is how this is ultimately implemented. So for example, you do have the $375 billion small business fund. We have to watch and see how that's implemented. There will be other programs, this Fed's Main Street Lending Program. We have to see how that's implemented. We have to see who does get hired to manage assets in the course of this. One of the things that the Democrats insisted on as part of this, which is, I wouldn't say is a game changer, but it's helpful at least at the margins, is there will be a congressional oversight panel created, 5 people appointed by the different leadership members of the House and Senate that will be overseeing how this money is allocated, spent, and so forth. And if you want a fun fact, for those of you who might not remember, there was a similar, they took this exact model from the TARP oversight panel, and the first chairperson of that panel was Elizabeth Warren, and that is how she rose to her current fame. I'm not saying the next chairman will rise to his or her current fame. I'm just saying that there is a precedent for this. I wouldn't say, again, it was a game changer last time. It produced a lot of reports and so on, but it doesn't have actual authority. So I think we're going to ultimately have to look to Congress to the extent we don't feel that this money is getting fairly distributed to try to rectify that as this gets implemented.
Well, Steve, we know that through the small business piece that's included in this legislation, there's the opportunity for small business loans that can offset payroll tax savings and a variety of things for small businesses. One of the things we know is that there's been an increase in Black entrepreneurship over the last 10 years, where businesses in general have risen by about 34% in the Black community, salons and a variety of other things that are important. While those numbers for other racial groups have fallen. If you were the czar to administer this small business fund or this portion of the legislation, how would you help us think about either the redirect or the assurance that those funds would find their way into the hands of Black business owners who are clearly driving the entrepreneurship economy today?
Well, if I were the czar of this small business program, which I'm not, I would make sure, and we went through this, on autos in 2008, 9, not in the context of minority-owned businesses so much, but just in terms of how do you allocate, in our case, ultimately $82 billion in a way that's fair and solves the problems and puts the money in the right places. And so I would simply, if I were running this program, I would simply make sure as we go through, people are going to be submitting applications for help, and there are various criteria they have to meet in terms of employee retention and things like that in order to get this money. I would make sure that in the context of evaluating these applications, that we gave full and fair treatment to the Black community, to all minority communities, to everybody across the board. I mean, there is a danger here, especially when funds are limited. And right now, as I said, I think everyone who knows anything about this would agree the amount going to small business is too small to address the magnitude of the problem, which means some people are going to get it and some people aren't. And that always creates the possibility of favoritism. And I would make sure there was no favoritism. I'm not the czar, and therefore I think it falls to us. And there's a lot of people on this call I know who have a lot of political influence to watch how this actually works and to pay close attention. And then to the extent it's not working the way we think it should, to apply the political pressure I think we have to fix that.
One of the quick points I'd like all of us to keep in mind is that these loans are potentially forgivable to small businesses, at least as I've read this portion of the legislation, for as long as there is a preservation of jobs for that particular business and certain criteria met. So I think linking the forgiveness for these loans with job maintenance, if you will, maybe not growth, but maintenance, is going to be a really important factor. So we should think about across our network how this particular piece and the forgiveness for the loans and the advantage it can set for small Black businesses may actually help. It's buried in there, but I think it's a really important distinction.
It is, Tony. One of the thought that's just crossing my mind is that there's probably a role, and it might be for BEA, it might be for some other group, but there's probably, there's going to be a lot of paperwork here. There's going to be a process to get these loans. As you say, there's a bunch of criteria that you have to satisfy and agree to in order to get the loans, of which maintaining your employment is probably the most important one. And so there's probably a role for some organization to go out into the Black community, among the Black entrepreneurs, and help them through this process and make sure they know what's available, make sure they know what they have to do to get it. A lot of these are obviously very small businesses, shops and restaurants and things like that. And there may not be the same level of sophistication in the Black community about some of this as there is elsewhere. And so there's probably a role for some organization to facilitate making sure that a maximum amount of this $375 billion finds its way into the Black community.
That's a good point. We just reached out to the National Association of Minority Suppliers yesterday. They have a program for training people on how to apply for these sorts of programs. So we're trying to see if we can get that to scale up, and they have courses already developed. So we're doing exactly that.
Great.
But you mentioned favoritism earlier, and I noticed in the bill there's about $2 billion set aside for Native Americans. There's about $20 billion set aside for veterans. I guess I'd describe that the first group is a historically suppressed group, and the second group made great sacrifice for the country. You could argue that the Black community is in both of those. And so I'm just wondering how to think about, is this the time to ask for some sort of dedicated fund, urban renewal, I won't call it a reparation, but some sort of fund to invest in the Black community? How does that work? How does that get evaluated? How do those two things get in there and nothing for other groups, I guess? Do you think this is a good timing to try to put that on the table?
I think there's definitely something that you guys can and should do. Look, I think you mentioned a couple times lessons learned going in the auto thing and in the general financial rescue. I think I would look back on that, and I think many of us would look back on that as a matter of both fairness and, frankly, as a matter of better politics, if you will, in a sense. We should have last time around allocated more money to communities, to individuals, to particular groups like Black-owned businesses that are suffering. It was very much a top-down approach. We saved the auto companies, but I'll just give you an example. We put $82 billion into the auto companies, but when Detroit went bankrupt, the Obama administration couldn't get any money out of Congress because the Republicans at that point controlled it, and it was only able to scrape together $300 million to help Detroit out of its bankruptcy. And so there was a level of unfairness then, and I think the way to achieve it now is by trying to organize your political power and the political power of people who agree with you about this. I think this bill, frankly, this ship has sailed. This bill is done. It's going to get passed and signed tonight. I think everybody, as I said earlier, thinks there's going to be a phase 4 of some unspecified nature and context. And what I would suggest that we do between now and whenever phase 4 arrives is to put together a package of what we think the minority community needs, both business and non-business for that matter, and then begin to use, again, your political influence and other people who agree with you on this to start this, to get this front of mind so that it ends up in a phase 4 piece of legislation. I think that's the path forward. I don't think there'll be, for example, I don't think there'll be many more standalone bills addressing this issue or that issue. I think they're going to try to do these in packages. And the next one, as I said, is phase 4, and it's probably a couple of months away.
So a couple other questions that came in from the audience. Someone asked why wages remain so stagnant while expenses, healthcare, insurance, et cetera, continue to increase. And then a second one related to mortgages, rents, and utilities. How they're being treated, will there be forbearance?
Well, let me take the first one. So we have had a problem in this country, and it goes all the way back to the Great Recession, where wages have simply not kept up. And corporate profits were anyway, they've got their own set of issues now, but corporate profits were we're doing enormously well. We're very high, record heights, record profit margins, even while wages adjusting for inflation for the average worker didn't really move. And that was still the case, much to the surprise of many economists, when unemployment was down in the 3.5% range. Everyone would have predicted that wages would have started to move up simply on the supply and demand of labor and so on and so forth. There are a number of reasons, I think, why that didn't happen. They include things like the declining power of unions. They include things like what's called the monopoly power of employers, where employers, for example, they were, crazy as this may seem, they were requiring non-competition agreements from like fast food workers. They couldn't work for another fast food outlet in the neighborhood. Now that has been done away with happily. But there were a whole bunch of structural reasons why wages simply didn't move. A big one was globalization, that if, in a sense, if a company would say to its workers in so many words, if you demand more wages, we're simply going to send these jobs to China, use Chinese suppliers and so forth. And so this was a significant problem before this virus arrived, of the disconnect between corporate profits and wages, between inflation and wages and so forth. And this recession that we're in the middle of now, or even at the beginning of now, is simply going to make that worse. It is simply going to give workers even less bargaining power, even less ability to command higher wages than they had before. And so at some point, and this is obviously not front of mind, frankly, at the moment because of the virus and so on, at some point, we also need to dig in on that issue of how to provide more, re-level the playing field, give workers more bargaining power, more ability to command higher wages. On your second question, I don't want to pretend to be an expert on all the details of how this is going to work. I would note that all the federal agencies that lend money, Fannie, Freddie, the Federal Housing Authority, people like that, they have all basically said they are going to stop evictions, they're going to stop foreclosures, they're going to have forbearance. And so I think the government is going to do what it can to help ordinary Americans pay their mortgage bills and things like that. On the other hand, obviously, if someone is a tenant in an apartment house with a private landlord, there isn't much the government can do about that. I think you'll see some private landlords offer forbearance because it's in their interest. Otherwise, the tenant leaves, they have an empty apartment, nobody to rent it, and so on. But there's clearly going to be an uneven response here. There are going to be people who are able to get forbearance, are able to get help with their housing costs. I don't think there's really a scope or a avenue to really help with things like utilities. Those are, again, private dealings. And then there'll be other people who get left out of that. And what we have to do is watch for who's been left out of it and then see what can be done by way of either government assistance or regulation to try to make their lives easier.
Just more of a philosophical question on, we're getting used to being working separated now. How does this permanently change the economy going forward? Just based on your gut feel, will we be back in stadiums in 6 months all sitting together, in a restaurant sitting 3 feet away from each other in Manhattan, or people think of it differently and just some things we won't do the same way?
Well, that is philosophical and way outside of my area. So you guys should chime in too, because you will have an equally or better idea. I think a few things. I think it is almost certainly going to be longer rather than shorter before we're back to anything that looks like normal. I mean, obviously, Donald, the whole idea of Easter is pretty ludicrous. As probably a lot of you know, Washington, D.C. announced essentially a lockdown till the end of April. So that's obviously way past Easter just for that one city. There's no sign in New York of things getting any better. I've been on a few calls with public health people as part of trying to be an investor to understand all this. There's a feeling among public health people that places like Florida and Texas and across the South between those two states hasn't even started yet, and that they're not really very well prepared, and they're may well have the same problems we're having up in New York and Seattle, places like that. So it's very hard to see the end of this movie, so to speak, to me, and how life immediately gets back to normal. I was talking to somebody the other day, and he said, think about the question this way: do you imagine in September schools and colleges and universities are going to be back to normal or not? And I guess my response to that was, I couldn't imagine they wouldn't be. In other words, the idea that we're not going to start the school year in September is just so, I don't know, depressing a thought. I couldn't even imagine it. But on the other hand, I have trouble imagining that exactly how life gets back to normal. I think we've all become very sensitized to the risks out there. Speaking for myself, it's going to be a lot. I don't think I've never been on a cruise ship, and I can't imagine now I would ever go on a cruise ship. I think it would be a long time before I go into a movie theater and I'm sitting 2 inches away from somebody, or a sporting event, an indoor sporting event in that situation. We'll see. Presumably eventually we'll all get over that. And then the third piece, Charles, that you alluded to is are the way we function, our lives going to change? I've learned how to use Zoom, which is amazing. After watching IT people in my office try to get a conference call set up for the last 10 years, a video conference, and it never works. This is amazing. And so I think we've all learned how to do some things differently. But I do think when this is over, by and large, our routines will go back to some version of normal. We were already starting to order more stuff online. That'll continue. I don't think it's going to mean we'll never go to a store again. I don't think it means we're going to shut down offices and everybody's going to work remotely. I can't wait to get back to my office, and I hope my colleagues feel the same way. So I think that for the most part, we'll go back to normal, and there'll always be a few things as you look at past crises, that'll be different. But What I don't, so I do think we'll go back to normal. What I really just don't know is what's the time frame.
Steve, let's build onto that if we can. So we as I think a country are used to enduring anything and moving through that through a defined period of time. And there are a lot of us who believe that this will end at some point and lives may be different, but there will be a finite end. What if we're wrong? What if there's a second blip in the fall such that, the early reports that Africa is now actually seeing and it's experiencing its own set of increased cases as they approach their fall and winter season? And what if, as a result of losing the opportunity to contain the virus, we actually do see a second blip in the number of cases? What do you think that means in terms of security in the markets for people who rely on the capital markets as we do in the biotechnology industry? What does it do to confidence? What does it do if we think that this stimulus package or this recovery package may actually afford some temporary relief, but this isn't a one-off. This is something that we have to live with for the next 18 to 24 months or so until we either have good therapies or vaccinations. Just stare into the crystal ball and for a moment, let's assume that this doesn't end in July or August or September, but it's with us for a while. What's the longer term set of economic solutions we should be thinking about?
Well, first let me talk about the problems. I'm going to try to figure out the solutions. The market today is, I think, essentially pricing in something like that economic forecast I showed you at the beginning of the call. Very steep decline, not as steep of a rebound, but a significant rebound, and then eventually we get back more or less to where we were, similar to other recessions. And as you saw in that chart, it's basically assuming that the economy gets going again in a very substantial way starting, let's call it July 1st, the third quarter. If that doesn't happen, it will, or some version of that doesn't happen, or if we do get back, and as you say, there's a second wave in the fall, it would, I think, my instinct is it would be disastrous for the economy and for the markets. I think people can stand a shock like this once, another shock like this where there's then no obvious solution or end of it. Maybe it's a vaccine in 18 more months or something like that. It would be, I can't even think of another event, certainly not in American history. You'd have to go back to, like the Black Plague in the Middle Ages and things like that, where economies were essentially completely set back decades of progress by an event like this. And so it's really hard to even contemplate it because I think it would be consequential beyond our imagination. If it happens, we would have to just keep doing versions of what we're doing. There are no other plays in the playbook. Let me put that out there. The playbook that you see being played is basically, we're firing a full range of artillery at one time. And that's a lesson learned from 08-09, which is not to piecemeal it out, not to worry about whether it's too much federal debt or whatever. We're firing all the guns. And we can fire them again. We can reload them and fire them again. We don't have any different kinds of guns. We don't have any other magic solutions. We don't have any other great ideas. Maybe some will emerge out of this. Some of what, as I said, much of what we're doing now was developed in 08-09 as policy tools. So we're using that knowledge. Maybe we'll figure something else out, but it's not obvious to any of us what it would be except to just keep doing what we're doing. But the longer this goes on, second waves, panic, fear, people refusing to leave their houses, the financial and economic consequences for everybody, from people at the top all the way to people at the bottom, are enormous.
Okay, well, I think we reached our time. Tony, you want to summarize?
Yeah.
Thanks a lot, Steve.
Well, Steve, thank you. We can't thank you enough for the generosity of your time and your insights. We're all smarter at the end of this 45-minute period of time, and we owe that to you. I'd invite everyone attending this call to join us again for the second in the series. It'll be Friday, 1 week from today at 11 a.m., where Jay Johnson, the former Secretary for Homeland Security, will be talking to us and educating us on the security aspects of this pandemic and what it means for everyday Americans and what it means for the country. We'll be exploring topics like that in the rest of this series. We will eventually turn to politics once we ground ourselves in the facts and in the data, both economically and what it means to us as a nation from a security point of view. But Steve, you've been terrific as always. It's great to see you. Please give Maureen our best, and you guys stay safe. And each one of you, thank you for joining us, and please do stay safe, and we will see you in a week. Thanks very much.
All right, thanks, Steve. Appreciate it.
Thank you. Thank you so much for having me.